Thank you for joining us for today's webcast on Massachusetts sales and use tax requirements as it relates to the construction industry. My name is Jeff Rogers. I'm a tax partner in the construction group at Feeley Driscoll, a Boston-based regional accounting firm. Feeley Driscoll has over 40 years of experience helping clients grow their businesses. If you wish to contact us after the webcast, please call us at 888-875-9770 or visit us on the web at www.fdcpa.com. Today we're going to talk about the Massachusetts sales and use tax requirements as it relates to the construction industry. First, a general overview of the sales and use tax law in Massachusetts. Massachusetts imposes a 6.25% sales tax on the sales price or rental charges of tangible personal property sold or rented in the Commonwealth. Tangible personal property is the key term there. Tangible personal property is more or less property that you can pick up and move, whereas when we talk about real property, we think of property as generally immovable, like land, buildings, and permanently affixed equipment. The buyer pays the sales tax to the vendor at the time of purchase, then the vendor remits the tax to the Commonwealth. This is pretty straightforward. There's another tax that Massachusetts imposes, and it is called the use tax. The use tax is imposed on the storage, use, or other consumption in the Commonwealth of tangible personal property purchased from any vendor or manufacturer, fabricated or assembled from materials acquired within or outside the Commonwealth. The same 6.25% tax rate applies. Now, just to be clear, this is a counterpart to the sales tax. It is not a double tax. With the use tax, what they're trying to do is ensure that tangible personal property does not escape taxation in Massachusetts. They are trying to protect themselves from people that buy something in New Hampshire, where there is no sales tax, and bring it into the state of Massachusetts for use or consumption. Since you do not have to pay sales tax to New Hampshire, you have to pay sales tax to Massachusetts on the back end. Now, even if you buy materials or some other form of tangible personal property from a state that does have a sales tax, you still do have an obligation to report those sales to Massachusetts. What they will do is give you a credit for the taxes that you have paid to the other state. If the tax rate in the other state happens to be lower than in Massachusetts, then you have to pay the difference. In this instance, you, the consumer, are responsible for remitting the tax to the government, unlike with the sales tax where the vendor is taking care of that requirement. Now, in the case of the construction industry, it can be confusing because you have a lot of parties that are involved. There is the building owner / customer, the general contractor, there could be several subcontractors, and then, of course, the vendors and suppliers of the construction materials. The state's view on a construction contract can really be summed up in a quote from a case back in 1982 called White v. PV Construction. In this case, the court stated that construction contracts are not contracts for the sale of bricks, window frames, or caulking material, but contracts for the construction and sale of a building. What this is really saying is that when a contractor is engaged in a construction contract, the customer is not purchasing tangible personal property from them, but rather they are purchasing a building. And a building is real property, and real property is not subject to sales tax in Massachusetts. With this being the case, the question would be, who does pay the sales tax on a construction contract? The answer is that it is the contractor that is considered the consumer of tangible personal property in Massachusetts. So when he or she goes to the supply house and buys lumber, bricks, or any other materials that are needed, they are purchasing tangible personal property at that point, so the supplier must charge the contractor sales tax on that purchase. And then there's no further sales tax charged throughout the contract. This is referred to as the contractor rule, when sales tax is paid on the materials at the point of purchase. So does that mean that the contractor is always the consumer? We should first look at the definition of a construction contractor, which was laid out in a case called Ace Heating Service versus the State Tax Commission in 1976. A construction contract is a contract for the construction, reconstruction, alteration, improvement, remodeling, or repair of real property. In the case of Ace Heating, the taxpayers were heating contractors. They sold, serviced, and installed hot water and steam generating boilers, related equipment, materials, and supplies. The court ruled that the property in question was purchased for the production of a finished product that would be incorporated into real property and was not for resale. Let's focus on that term resale for a moment. There are instances where the contractor is not considered the consumer, but instead is considered a retailer selling tangible property in the same manner as any other retailer. The contractor is considered to be purchasing tangible personal property for resale when he installs a complete unit of a standard item of tangible personal property that requires no further fabrication other than installing, applying, or connecting services. For example, if you hire a plumbing contractor to supply and install a bathroom sink or toilet, They are in all likelihood not constructing the toilet or sink themselves. They are going to a supplier, buying a complete unit of tangible personal property, and installing it. The contractors view no different than an associate from Home Depot that could sell and install the same item. In this instance, the sale of that sink is considered a resale, and rather than the contractor paying sales tax to the supplier, the contractor must issue a resale certificate letting the supplier know that he or she is going to be merely reselling and will take the responsibility of paying the sales tax themselves. In this case, the contractor is required to charge the customer sales tax and remit it to the government. The contractor should be breaking out the installation charge separately in the invoice, since only the actual tangible property is subject to sales tax. If the contractor does not break this out, then sales tax must be imposed on the entire bill. There are a few different cases and rules that really nail down the contractor rule versus resale rule. We will start with letter ruling 06-03, which involves storage sheds. In this case, there was a taxpayer that constructed sheds, all customized to the client's specifics. The taxpayer would transport all necessary material and equipment to the job site, and the field labor and subcontractors who would construct the sheds, including the installation of the doors, windows, roofing, and siding. The ruling from the Department of Revenue was that because of the custom nature of the shed, the contracts were considered to be for the construction, reconstruction, alteration, improvement, remodeling, or repair of real property. That contractor rule would apply. Now keep in mind, if the contract were merely for a standard prefabricated storage shed that only required installation, then the company would have been considered a vendor of tangible personal property and would be required to charge sales tax to the customer on the sales price of the storage shed. The moral of the story is that you have to do more than installing. You actually have to be doing the construction or fabrication work yourself to take advantage of the contractor rule. Closet storage systems were addressed in letter ruling 94-6. Keep in mind that the type of property that we're discussing, sheds, storage systems, etc., is not important. It's the concept of tangible personal property versus real property that matters. There was a company that built closet storage systems designed specifically for the needs of customers. They were custom fabricated to the specific dimensions of the customer's storage space and physically incorporated into the real property. Again, these were ruled to be construction contracts due to the customization and installation in a manner where it was permanently affixed to the real property. And then in 2004, there was a case called Classic Kitchens versus the Commissioner of Revenue, where the taxpayer was in the kitchen remodeling business and they ordered and purchased partially constructed cabinets and countertops from third-party vendors. They then performed significant alterations and finishing work at the job site and installed the cabinets. The cabinets and countertops became so integrated with the structure that removal would render them useless and cause damage to the surrounding structure. The ruling was that the taxpayer was not a vendor of cabinets and therefore not required to charge sales tax to the customer. Again, the contractor rule applied. What was interesting about this case is that 10 years later, in May of 2014, Massachusetts came out with a Directive, 2014-2, and in this directive, they revisited the Classic Kitchens case, and while they agreed with the ruling, they wanted to make it clear that the original manufacturer that sold Classic Kitchens the partially finished cabinets would not be considered a contractor, because at the stage that they were selling the item, it was tangible personal property, and so they were required to charge the contractor sales tax. There are a couple instances where the resale rule applied. In letter ruling 85-68, this centered on an electrical contractor that wired an alarm system into windows and doorways of a building. Since there was no significant alteration to the real property, they were considered to be reselling alarm systems and just merely installing or connecting them. So they were required to issue a resale certificate to the vendor and charge sales tax to the customer. One of the major cases that centered on this issue was the Anthony Galluzzo Corporation versus the Commissioner of Revenue in 1997. In this case, the taxpayer, the Anthony Galluzzo Corporation, supplied construction materials and also performed custom millwork for its customers. They entered into two different types of contracts, a furnish-only contract and a furnish and install contract. With the furnish-only contracts, they performed millwork to the customer's specifications at their facility and then transported to the customer in Massachusetts and delivered to the job site. And then that was it. No further installation provided. The furnish and install contracts were basically the same, except that they did do the installation themselves or through a subcontractor. Based on the two different types of contracts, you had two different sales tax requirements. With the furnish-only contracts, because they did not affix the tangible personal property to real property, they were selling tangible personal property to a customer, and therefore they were required to charge sales tax. On the furnish and install jobs where they were doing the installation, they were considered contractors. As you can see, a lot of the treatment hinges upon the installation function. You can have one instance where if all you are doing is installation, you are not a contractor, you are a retailer. However, in another instance, where you are doing the construction and fabrication work, if you do not do the installation, you are also a reseller. Basically, what it comes down to is to get the contractor treatment, you must both construct or fabricate and install. One of the other aspects of the Galluzzo case that I did not focus on before was that this company was based out of New Hampshire, and as such, they were not paying sales tax on anything up front. Massachusetts tries to protect themselves from out-of-state contractors because it would not be overly difficult for an out-of-state contractor to circumvent the sales and use tax requirement. What they require is that a non-resident contractor must deposit 6.25% of the total contract price with the Department of Revenue or furnish a guaranteed bond to secure payment. The state will then issue a certificate of compliance to the out-of-state contractor, which they would present to either their customer or the general contractor, if they are a subcontractor. If the out-of-state contractor does not supply a copy of the certificate to the general contractor, then the general contractor is supposed to withhold 6.25% of the agreed-upon sales price and remit it to the government. The 6.25% is on the total contract, which, when you think about it, that includes a lot more than what would typically be required, since Massachusetts does not impose sales tax on labor or any other profit margins. In order to recover this amount, the subcontractor must file their sales tax returns and prove to the state that they have satisfied their filing requirements before the bond or deposit can be released. If the general contractor does not comply with their requirement, then they could become personally liable for any unpaid sales tax should the out-of-state contractor go out of business. I would like to conclude this with a brief overview of the filing requirements for contractors that have to file sales and use tax returns on their own. The filing frequency is based upon the amount of tax that you are expecting to collect from your customers during the year. If you think that you are going to be collecting $100 or less for the year, you can file annually. If you are between $101 and $1,200, you are a quarterly filer, and more than $1,200 will make you a monthly filer. The return is due 20 days after the end of the filing period. If you are a business that has combined annual withholding, sales and use tax, and room occupancy tax liabilities of $5,000 or more in a year, you are required to file your returns and make your payments electronically. You will do all of this on their WebFile website. Once you've reached the $5,000 electronic filing threshold in any one year, you will have met that threshold for all subsequent years, and you must stay as an electronic filer. In addition, any zero tax due returns are required to be filed electronically, regardless of the total business tax liability. As a rule of thumb, we often say that once you have started filing sales and use tax returns in Massachusetts, or really any other state for that matter, your best bet is to continue filing zero returns on a go-forward basis. If you do not, the state has no way of knowing whether or not you really did have a filing requirement, and they will assume that you did and send you out a notice. Oftentimes, they will estimate what they think the tax is due. Therefore, you are better off filing something with a zero on it, which will satisfy your requirement. And with that, we're going to conclude our webcast on sales and use tax for Massachusetts contractors. Thank you again for joining me today. My name is Jeff Rogers, and if you have any questions, please feel free to contact us at 888-875-9770 or visit us on the web at www.fdcpa.com. Thank you.